Hello and welcome back to the Starter Glamping Business Podcast. Got a bit of a special episode for you today. We've had a few of those recently. I'm joined by my monthly co-host Connor Schwab from Sage Outdoor Advisory, and also my business partner, I suppose we'd call him, Lee Pritchard, who is the CFO of our brand new glamping revenue share startup, Posh Outdoors. If you haven't heard about Posh Outdoors, we did a special episode a couple of weeks ago where we interviewed our board member Ben Wolfe, the leaseholder for our first partnership, Crystal from Skyridge Glamping. But essentially, it's a luxury glamping revenue share startup where we send luxury year-round glamping units to landowners or leaseholders, primarily existing tourism businesses, at no upfront cost to the partner. And we split the revenue. So there's full details in the description of this episode with our full deal page. Anyone has any questions, just shoot me an email or review that deal page. We are actively looking for investors. So if anyone wants to invest, then just let me know. But that's the kind of core concept in a nutshell. And today we're going to be talking about Posh and our initial project, but we want to approach it from in a way that's going to be useful for everyone listening, regardless of whether you have an interest in Posh or not. We've been in the weeds in this project in terms of trying to raise money, in terms of projecting numbers for our first project. So, there's a lot of work that's gone into it. There's a lot of learnings that we've all taken from it. And we hope that those kind of discussions are going to be useful for everyone today. So I'm going to be the host today, guiding the conversation. Lee is going to be the interviewee, I suppose, talking about his role and what he's been doing in working on our initial projects. And then Connor is going to be the kind of neutral third party who is going to be asking all the difficult and nitty-gritty questions. So Connor, welcome back to the show. Lee, welcome to the show. Connor, could you just give, for anyone who hasn't listened to your episodes, a quick 30-second recap of your background, and then we'll go into more detail in Lee's background.
Yeah, thank you, Nick. And thanks for being here, Lee, as well, and allowing me to join. I'm the vice president at Sage Outdoor Advisory, and what we do is feasibility studies and appraisals in the outdoor hospitality industry. So that includes campgrounds, RV resorts, and glamping. And I'm kind of the glamping specialist on our team. But feasibility studies and appraisals, that essentially means that we're standing between landowners and operators and the money. So banks and private investors, and we go in and we look at a business proposal, and then we go in and look at the market, and essentially we'll do the financial projections. So we're kind of the numbers nerds. And then my MBA was also in with an emphasis, or my thesis was in glamping. So I've been kind of doing this a long time, and I guess that's the background.
And of course, the highlight of the CV is the co-host of the Starter Glamping podcast. Yeah.
The highest pedigree.
Lee, you've got a super cool CV. Do you want to just run us through your background?
Yes, I'll try and be brief. Thanks, guys, for having me. Connor, it's been great getting to know you recently, and look forward to many more discussions beyond today. But I'm co-founder and CFO of Posh Outdoors. So I'm a numbers guy as well, Connor, and started my career in public accounting at a firm that is no longer in existence. It was quite a great firm, but it's no longer around. But then left accounting and got the entrepreneurial bug, and have been involved in consumer-facing businesses, and kind of the common theme of those, they have all been businesses that have transformed the consumer experience in one way or another. While I'm CFO of Posh, I've also been CEO, and sometimes the dual CEO, CFO role. And then I had one pure venture startup, which had the luxury of adding a CFO to the team there. But we went from zero in revenue to over 100 million, and we were on the Inc. 500 number 73 for our early phase of growth. So that was super exciting. And in terms of what led me to Posh Outdoors, Kevin O'Brien, who is our co-founder and CEO, he and I were in business together, our very first ventures, and had a nice exit to a public company, and that was in the late 90s. and we've looked at doing a number of businesses together since then. Nothing ever materialized, and just pre-pandemic, we were uh, pretty far along in launching an apartment hotel model, kind of similar to WeWork on the office side, where it's a lease arbitrage model where you uh, take space on a long-term lease and then market it for short-term stay. And so we actually had a term sheet for our Series A financing on the table in March of 2020, and little thing called the pandemic derailed that business. Luckily for us, because we kind of were able to watch from the sidelines as that business model disintegrated kind of before our eyes. But the one thing it did do is it introduced us to the whole short-term stay ecosystem, which then led us to the glamping opportunity. So sorry for the length of that, but that's kind of my journey to Posh, if you will.
Yeah, and Lee, could you just tell us a little bit about why you're so excited about this as an industry and why it caught your eye? You know, given you've got plenty of options as a serial entrepreneur, you've had your fingers in many pies. Why does glamping really attract you?
Well, from personal experience, I love the outdoors. I love hiking. I love skiing. I love golf. It's so. However, my wife and I were never big campers. And so, really, my favorite place on the planet to stay, used to be able to afford it. Now it's unaffordable, but there's a place called the Post Ranch Inn out in Big Sur, and they have ocean houses that are built into the side of a cliff. And so you go there and stay, and then you hike the trails around Big Sur, and it's just incredible. And so what I love about glamping is the attraction to people who would not otherwise buy an RV, rent an RV, or go to a more traditional campground. So it's bringing, outdoor experiences, meaningful, memorable outdoor experiences to the masses.
Lee, you're a numbers man, and you haven't once mentioned the numbers. Come on, there's got to be some of the financials that attract you to glamping as well. Don't give me that
Well,
rubbish about loving the
there's,
great outdoors.
it's there is monstrous demand and very little supply in luxury glamping, and so that leads to a fantastic business opportunity. And
There we
so
go. There's
that
the honest answer.
that is super exciting, right? So I
Fantastic. And
think
so,
back when Kevin was telling me about what type of night ADRs and occupancy rates that some of the luxury boutique glamping operators were getting, and I didn't believe him. I was like, that there's no way. And so I live in Atlanta, Georgia, and he found one up in Chattanooga, and sure enough, I try and book a 2-night stay and look 3 months out, and I can't find anything that'll work with my calendar, and the rates are $600-700 a night. So I said, well, this is worthy of further investigation.
there we go. There we go. And that's just one thing I'd emphasize as well, not to get all pitchy, but this team that we've assembled is a mixture of glamping industry professionals, but also people with a serious background in successful entrepreneurship and doing big deals with venture capital and things like that. So we're really excited about the team and to have Lee and Kevin on board to add to that glamping experience that we've got as well. So the rest of this podcast is going to be focused on what Posh is doing, but we really want to emphasize that it's not just a Posh Outdoors sales pitch. We're going to be going through our thought processes, the considerations we've had, the criteria that we kind of assess different potential partner locations by. So this is going to be useful for everyone to kind of get an insight into our thought process and how we're approaching this deal. So obviously the core concept behind Posh is that we send luxury glamping units to landowners or leaseholders, and that involves assessing locations in terms of, the quality of the actual physical location, also assessing the quality of the partners who are actually going to be operating the site on the ground. So Lee, obviously Posh has a deal signed with Skyridge Glamping in the Rocky Mountains of Canada. That's due to be our first project, assuming we raise the money in time. How first of all, how did that deal come about? And then in terms of the wider discussion, how do you assess the potential locations and the potential partners when we're deciding who to partner up with at Posh?
Absolutely. Uh, so three of the four founders are currently residents of either Alberta or Saskatchewan. And so Kevin, our CEO, is uh, just a incredible business development executive who, if you give him a name, could be the CEO of a Fortune 500 company, uh, within 3 to 5 days, he will have an appointment, a phone call, an online meeting with that person. It's just, it's remarkable. And so, and I'm not sure how much he sleeps because, I usually will wake up and, have 30 emails from Kevin on different ideas and opportunities. And so one of the key phone calls that Kevin made was to our other founder, Edward Haynes, who started and runs EJH Distribution, who handles North American distribution for both DeWard and Tubo, the two units that we currently have lined up. And Ed had contact with the Skyridge proprietors, and then introduced Kevin, and we introduced our revenue share program to Skyridge. And so that is the background there. That is a long-term land lease on Crown land that the Skyridge folks worked tirelessly on for several years. And so it's really, an honor for that to be our flagship site, and obviously super excited about it because the chances of somebody building next door are quite remote.
Yeah, and it barely took any consideration when you saw the property that we were working with at Skyridge. So I mean that the location wasn't even an issue, and the operators on that property, Crystal and Robert, as we'd said in the previous in episode 2 weeks ago, they'd already exited a glamping business in New Brunswick, so they knew what they were doing and they know what they're doing. But obviously, when we're looking to future partners in the pipeline, not everything's going to be unbelievable crown land property that they've spent 3 years getting a lease for. There will be kind of a set of criteria that we're applying. So what are we looking at in terms of quality of location, quality of partner? What are the kind of criteria that we're kind of setting to find those kind of iconic properties and make sure that we're going into the right deals with these people?
Sure. A lot of factors, of course. And so since, we've got this supply demand imbalance right now, but, part of the reason for our rev share structure is to help solve that supply demand imbalance. And so, over a long period of time, as the supply catches up with demand, uh, obviously iconic sites will be a key differentiator, and sites with high barriers to entry. And so, the 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 location is obviously foundational, for several reasons. But and then of course we want the iconic surroundings for the units, and I'm sure Connor will have a lot to add in terms of the what's the area GDP, what's tourism spend look like, what's tourism projected growth, is the government supportive of tourism. Also looking at least for our particular model, we kind of take a look at what is the 4-star plus hotel landscape like, and what does what kind of rate and occupancy is that area experiencing? What's proximity to an international airport? Is there existing on-site food and beverage? If not, are there a lot of choices within a 20 to 30-minute ride? So a number of factors. What did I miss, Connor?
Those are definitely the big ones. I think one of the things that we try to spend a lot of time looking at is the what are we seeing as the rates and occupancy of hotels in the area, rates and occupancies of short-term rental Airbnbs, of any comps if there is any glamping businesses. But yeah, you mentioned the main ones, but being right in between a major MSA. I think Calgary is like 1.5 or 1.9 million in the MSA, and then Banff is 2 hours from there and receives however many, several million visitors per year.
The Rockies, there's a lot of money in Calgary and Edmonton, and even though Edmonton is, I'd say 3-4 hours from the kind of entrance to the Rockies, but people just go there for the weekend or for the week. That's the place they escape to, and it's Banff is known the world over, and we're pretty close to that, and so we think there's huge untapped potential in that area of the world and in Canada in general. Really, we've spoken to so many US based operators. We've tried to speak to a few more Canadian recently, but again, the landscape and the scenery in Canada is just stunning. And there just isn't the supply just yet, which we're certainly not on the West Coast. So we're really excited to kind of fill that gap. Diving into the numbers of our specific project, and again, we want to talk about these not just to show people what Posh is expecting to make, but we want to kind of talk about the numbers, because not everyone goes deep into the numbers, or not everyone's at the point where they're ready to go deep into the numbers. So we want to kind of be transparent about these kind of things. So Lee, do you want to just kick off by kind of going over what our main projections are for Skyridge once we have we're building in 2 phases, but once we've built out the second phase, which is going to be 10 units of 10 tiny homes and 10 Tubo units, what kind of numbers are we shooting for at this location?
Okay, so you can, when you look at a RevPAR number, we're kind of in
Can we
that
define RevPAR
315.
firstly?
Sure. Yeah, it's a combination of your average daily rate times your average occupancy rate, and so you can get to your RevPAR target a number of different ways. You can get there with a lower rate and a higher and a higher occupancy level, or a lower occupancy with a much higher rate. So we typically look at a range, and kind of assess what is the overall implications to the return. Kind of a unlevered yield on cost is kind of the number we look at. But we're very, very, very comfortable. So Skyridge obviously had done their own research, and then we came in behind them, and I think they've been pretty conservative in their plan, and we've piggybacked on their numbers. And so there's 2 different types of units. They've got skybox units for phase 1, which are manufactured by Rockbox, and then the second phase will be the Posh Tubo units. And so it'll be interesting to kind of see the relative average daily rates and occupancy levels there. But the cost basis of the Tubos are significantly higher, so we are expecting significantly higher average daily rate on the Tubos than we are for the Rockbox units.
Yeah. So headline figures. What's the kind of net operating? The revenue target for all 20 units, and what is the expected daily rate, and what's the expected occupancy rate?
The daily rate average, and so as we know, we're going to have big seasonality both within the time of year and then within the time of week. You get seasonality, so that's the average. We would expect that to be much lower in the ice cold months and much higher during the peak summer months. And then an occupancy rate of averaging 70% is how we've modeled it out. And so we then we 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 look at a sensitivity analysis running occupancy down, to 60% and as high as 90%, and also look at the impact on average daily rates and our overall EBITDA. So for the site overall, kind of in our range, and our rev share with Skyridge is 30% of guest revenues, and so that rev share rate will vary site to site based on both the RevPAR expectations as well as what suite of services does Posh provide to the landowner. And in the case of Skyridge, since you have experienced glamping operators, there really are no additional Posh services brought to the table. So the rate is 30%. And so our range of outcomes for the full 20 unit project is on the low side, net operating income of around 570 per year, and on the high side, just over $1 million a year. Expected average ADR is 460 a night, and that's kind of across both unit types, all seasons.
And the overall target for 20 units, taking out the rev share out of the equation, is that 2.4 million, right?
Yes.
Yeah, and Lee, would love to. How was it that you came up with, I think, ADR 425 and occupancy of 70%? Was maybe the main data points that you used for those benchmarks?
So the main data points would be the 4-star plus hotel occupancy in the Alberta Rockies, and then also the short-term stay is much more limited in Alberta than it is in a lot of the U.S. markets, and so while that is factored in, the hotel rate and occupancy is a big contributor. As you guys know, a well-run luxury glamping operation, it's not uncommon to outperform the hotel occupancy in the region. And in Alberta Rockies, the 4-star plus had been running in the mid to upper 70s, and so we feel like the 70% number for Skyridge is pretty conservative.
Yeah, and I could add, I did some of my own research into short-term rentals and hotel in the area, and it was occupancy was coming up in the high 60s, and that was just an average. It wasn't the 4-star, which is actually it's pretty strong. I'd say that's an above average market. And then also, what we've noticed from our experience is that properties that have a really high volume of units, it's a lot harder to maintain a high occupancy. But I think a property that only has 20 units is it's on the smaller side, particularly compared to hotels. Usually we'd start to say, like, when a glamping site gets into 40, 60, 80 units, then it gets pretty difficult. I would say 70% would be pretty aggressive. But I do think that, with 10 or 20 units and expecting to outperform the hotel market, just due to, there's 9,000 hotels in the Banff market from the data that we pulled, but I'd guess there's going to be less than 100 glamping units. Just kind of that supply demand we can see we tend to expect that to come in a bit higher.
Another sanity check on the whole region is, guys know our friend and Posh board member Ben Wolf and his company Oasi, and we had them take a look at the Alberta Rockies and kind of general area, and they were unbelievably enthused and thought, frankly, our numbers were low, and so that was for us a good sanity check. Now, what I will say is that you know numbers for target numbers for average daily rate and occupancy can be right on the money, right? But at the end of the day, it's all about execution, right? So you want to get what's achievable if you're executing, but if you fail to execute, then you may you may not achieve those, even though you really should.
Yeah, and obviously that's a big reason why we're so bullish on the guys that we've partnered with, Crystal and Robert, with their experience operating a glamping site. We think that's going to be pretty important. I do just want to pick you up on.
Oh,
Sorry,
I'll
Mark.
jump in. I'll just piggyback on you. You said butt in, so um,
Yeah,
I want to express the value of finding for your guys' first operators who have done this before. And then I think, allegedly, I think you guys mentioned they had a successful exit from a past company. But one of the most rare things that we see in our industry, 90% of the feasibility studies that we do in glamping or outdoor hospitality, if not 100%, they've they've never launched a project before. No one has glamping experience. So the fact that your guys' first location is in seemingly such a strong market, but that the operators have done this before is very, very rare. So that carries, tremendous value.
yeah. And one thing I want to pick you up on, Lee, that you mentioned earlier is you did a sensitivity analysis, and I don't think that's something that we've mentioned at all on the podcast, but I think it's a pretty good way of measuring and managing risk when you're investing in a glamping project, because obviously we've set these ADR and occupancy targets and expectations, but we've been pretty conservative with that, and we'd hope that we could actually exceed those numbers. But there's obviously you've got to consider the potential if we don't hit those numbers, and how much of a safety net do you have going into a project if you don't hit those targets? How far below the targets can you fall before you start to go from a good business to a worrying one? So could you just explain what a sensitivity analysis is, how you did it, and why you think it's useful to do one going into a glamping investment?
Yes, and so I've found the sensitivity analysis in looking at whether it's investments or projects or is just an incredible tool, because you really want to understand the ripple effects all the way down. Especially if you have a lot of debt on a project, it's like, okay, where do we violate our debt covenants? At what, kind of what is the level? And so you pick the key drivers, and the rate and occupancy in this business model are, that's that's a driver, that's the financial driver. And so at what point, you could still show that a resort makes money, but if you're levered up and have interest expense and debt service, you've got to understand at what point are we not cash flow positive. And then at what point, uh, you know, obviously you want to overachieve your numbers, and so it's always nice to understand the impact of overachieving, rate or occupancy by 5 points. It's like that's beautiful, and so where you have especially if you have a high fixed cost business. Um, so so in this, luxury glamping, rate times occupancy is key, and then how does that impact every single line item on your P&L? And so you have to separate, uh, what's variable, what's a variable expense, what's a stepped expense, and what's a fixed expense, and how do changes in my revenues affect each of those? And then you kind of, there's a lot of messiness and a sensitivity and kind of behind the scenes stuff, but you want to wrap up a sensitivity analysis in a nice little table and say, here's the outcome if these two things change dramatically while you're in the project.
And so for the most, obviously we've got into it in a lot of detail, but in the most basic form of a sensitivity analysis, if correct me if I'm wrong, that might be, for example, you've got daily rates in one line, you've got occupancy rates in another, then you have inputs for when each of those kind of things cross over. So in the top left corner you've got the lowest possible revenue that you'll be generating. In the bottom right corner you've got the highest possible revenue you'll be generating, and then that can give you a picture of, okay, here's if my targets are 20%, if my results are 20% below my targets, this is the revenue I'll be generating. And then that can go into further analysis where you look at how that affects costs and everything like that.
Yeah,
Is that right?
that's exactly right. I'll typically have tables that track it through. One table will show the impact on revenue. The next table will show the impact on EBITDA, and the next table would have impact on cash flow. So you can kind of break it down to different views.
So, Lee, one of the things that's obviously very important for any investor to be aware of before they put money into something like this is, what are the risks? What are the things that could potentially tank what would be like in ordinary normal circumstances the project would do great, but there's always unexpected risks, and whether that's something like a hurricane if you were in Florida, but maybe up in the Rockies. I know one really big demand generator is Banff National Park, and that brings in millions of people a year, and it's the main generator. And I know, like in Yosemite in California, they now have they now put a cap on how many people can go each day, and it's still millions of people annually, but it is just like does have an effect on that demand. And I was just wondering if you could maybe walk us through the risks that you see for this project, for your guys' project that you're fundraising for, and then how that affects the investors.
Absolutely. And so, one thing to clarify is that our current capital raise is, while the use of proceeds is to fund the Sky Ridge project, it's not a Sky Ridge only investment. So it's an investment in the broader Posh Outdoors platform. And so ultimately, the risk will be spread across multiple sites, multiple partners, and multiple locations. And so, but really specific to to any one site, be it Sky Ridge or others, I typically like to separate the risk into buckets of what are the external kind of macro risk factors, and those are obviously things that are beyond your control. And so you've got weather events and natural disasters. Canada did experience more than their fair share of the fire activity last summer, and so you've got things of that nature. You have general economic conditions and how those conditions affect the travel industry. We plan to do our first two sites with all equity, so the debt markets is not a risk factor for us in those first two projects. But for those that are developing their own projects, and people are certainly using debt to do that. If it's floating rate debt, you've got interest rate risk out there. And then from a financial performance standpoint, what are the cap rates on exit values for projects? The only other thing I can think of at the moment would be government policies, and so you kind of led, is there a cap on visitors, or is the border shut down, and so the all the tourist dollars coming from the states is not able to arrive in Alberta. So those are the kind of the external factors, and then more project specific is so key person, right? So there's a term in the insurance industry known as key person policies, and so if the success of a glamping site is totally dependent upon an owner operator or a talented GM, it sometimes following a legend and whatever it is tough to do, and so you could have a period of time where you don't have the right leadership in place if you were to lose a key on-site person. So that's certainly a risk.
So Lee, what you're saying is if I drop dead tomorrow, the whole thing's gone up in smoke.
You
Absolutely.
took the words right out of my
Yeah.
mouth.
Yes, absolutely. And so, I think those who have been involved with land acquisition and pursuit costs of great sites, and then doing the site planning, the zoning, the permitting, getting sign off from inspectors, seeing change orders come through, and huge overruns can be issues. And our Sky Ridge partners experience some of that. A lot of it was extra sensitive because it is on Crown land, and so those are all kind of general risk with glamping projects, and then competition. So with Sky Ridge in particular, we're very very comfortable that it would be several years before somebody could pop one open in close proximity to where Sky Ridge has secured their 35-year land lease, I believe it is.
Okay, so we're going to say that's the end of the episode for anyone who has no interest in investing in Posh. We obviously don't expect everyone to have an interest in that. So if you have no interest in investing in our projects, then feel free to click off and look forward to next week's episode. We're going to do, I think Connor and I are going to be doing a bit of a special 75 episode special on some of the biggest takeaways I've seen from interviewing the various glamping operators. So that one should be pretty good for everyone. But for those who maybe are interested in putting money in Posh in our projects or learning more at the very least, then feel free to stick around for the last few minutes. We're just going to go through kind of the opportunities that are available for potential investors. So as a reminder, we are doing a crowdfunding raise, so anyone can invest. Minimum investment is just $100. So Lee, could you just give us a quick overview of, let's say someone put in $100,000 tomorrow. What are we, and we always preface it with, this is an investment, it comes with risk, there are no guarantees. But what would we hope to return from a $100,000 investment after 3 years, for example?
I think, the way that we're really kind of allowed to talk about it is how we think about our plan and how we're going to raise the capital to execute the plan, and then a range of outcomes if that plan is achieved. And so this crowdfunding round is structured as convertible notes, and so the notes accrue interest at the rate of 12%, and they accrue interest until such time that we have a qualified equity financing. And so at that point, the notes would convert into the same security as issued in that qualified financing. So if you think about a 300 unit plan from 2024 to 2026, and with round numbers, including working capital, a couple $100,000 per unit, it's roughly a $60 million total capital need, and we'll be raising kind of the initial phase of the crowd fund is up to 1.2, and then we'll do an additional phase of the crowd fund to get us up to 5 million of convertible notes, and then we're targeting a 20 to 25 million dollar Series A capital raise in 2025. And then we're looking at roughly 50% debt as we to layer on. So, and then of course, as we ramp up, the deployment of glamping units throws off cash, which we then reinvest. So, overall, we see a need of around 50 million of total capital to execute the 3-year plan, and kind of based on a range of potential equity values, we see a $100,000 investment in a convertible note, being anywhere from a 10x to a 20x return as we get into 2027, and so that's kind of how we're thinking about it. We looked at the valuation range based on what's a reasonable cap rate range for the site operations, and then what is the Posh pipeline and platform value going to look like at the end of 2026? Because while our 3-year plan is to ramp to just under 300 units, it's certainly a model that could support scaling to 1,000 plus keys as we look through the remainder of the decade.
Yeah, and just to recap, we're doing the initial crowdfunding raise to raise enough capital to fund Skyridge, and then potentially also one other project beyond that. Then we will go, and in the meantime we'll be lining up. We hope a couple of 300 units in the pipeline for future projects, subject to additional capital. We'll go for the additional capital raise, within a couple of years. At which point the company gets a valuation. At which point, once we close that raise, the investment, the convertible note, will become equity based on that valuation, and then that's where the fun really begins. When the big capital starts coming in, and we can start deploying all of those units. Quick note on why we're doing rev shares versus ground up developments, Lee. What's the reasoning behind that?
Well, it's we talked about the major supply demand imbalance, and this rev share approach allows us to go to landowners that are very far down the process of having the site ready to go, and our units are modular. The key variation from site to site on the construction cost and time frame is what do the decks or unit platforms need to look like based on the site specifics. And so for us, I've actually visited a site that was ready to go for 10 units. Everything was permitted, all the utilities were pulled to each of the 10 sites, and the landowner had planned to add cabins. And so we'll be talking with landowners and building our pipeline, and there will be that landowners will be at various stages of having their site ready to go. And so for us, we're able to accelerate the unit deployments as opposed to spending our time identifying sites, doing the site planning, permitting, and all the entitlement process.
And there's an element of the land coming to us as well. Obviously, Glampitech generates a lot of leads. EJH Distribution has a lot of leads and contacts in, the ski resorts, for example. And, we think it's going to be a lot faster for the land to come to us. Also, we'll be doing our own outreach, obviously, rather than us having to go through millions of real estate agents and trying to find nice properties in different areas.
It helps when you have an industry-leading podcast about helping people start glamping business. I think that's the right audience for finding new land opportunities.
Yeah, I mean, we it's It's another reason why we're excited about Posh, because we've got different people in different niches of the industry. And yeah, I'm not going to toot my own trumpet too much, but we do generate a good number of leads, and that's why the land is coming to us rather than us going to them. Just to close off, Lee, could you give us a 1-minute summary of why you're so excited about this opportunity and why you think potential investors should be excited also?
I think it's a combination of introducing guests who would not otherwise be in the great outdoors to be able to really enjoy the outdoors. So we're bringing a whole new segment of guests. We've got a huge supply-demand imbalance in the industry, which is creating an incredible opportunity. And we've got the right model to rapidly deploy glamping units and the right team to execute on it. So super exciting for me.
And Connor, what are your thoughts on the overall opportunity?
Yeah, I think I'll maybe start with like the concerns or the risks. I think my first thought in investing in an opportunity like this is that the investor would be investing in POS, which is investing in the first location. So there's potentially 2 points of failure there with two different operators. So that's kind of one concern. But I do think that fundamentally Posh has the right people on the bus, as well as the opportunity at Skananskis. I've always messed up how to say that. Skanaskus.
Kananaskis.
Kananaskis.
Rocky Mountains.
I do think that Kananaskis has the right people on the bus, as people that have done this before, is a really rare opportunity. And I'm a big believer in Nick, because Nick and I started doing business development in the American glamping market at the same time. And he was brand new on the scene and has built relationships with so many people and sent us a lot of business at Sage, and is very well networked. So that gives me a lot of confidence and an ability to execute and get things done. The second risk, I think, is that winter glamping is something that's largely unproven, at least in the US, and it's not something that there's a lot of examples of. Most are highly seasonal businesses, but I am a believer that winter glamping is going to become more of a thing, and then it just requires having the right units, right, which I think you guys have selected for the job. And I think there's a huge appeal for people to still be staying in unique units even in the winter. And Banff's an incredible place in the winter. So those are maybe a bit of my concerns. But I think the best part about Posh, or that I'm most excited about, is in our work, in what we do, we see the struggles of the industry. We help people launch these businesses. So I know what the pain points are. And if you've listened to me on the show, the two biggest hurdles to the expansion of this industry and expansion of supply is, one, getting zoning and permitting to be allowed to run a business on beautiful land. And the second is a lack of capital. And Posh is solving that problem for the landowner and operator, the capital problem. So they go out, and the landowners and operators, they solve the zoning and the permitting problem, and you guys bring the capital to the table. So it's kind of divvying up those two main tasks. So I think it solves a real need. So yeah, those are my thoughts.
Amazing. And for anyone who is interested in diving into winter glamping, they can listen to last week's episode where we interviewed a glamping operator in New Brunswick in Canada. So give that one a listen. I think that's all, gents. Thank you. That was great. Hopefully it was of use to the general audience. Hopefully it was of use to potential investors. If you do want to get in touch about potential investment, first of all, you can review our full deal page in the description of this episode. And then if you scroll down and hit invest, it will take you to the crowdfunding page we have. Anyone has any questions, if anyone with serious interest in putting a decent chunk of money in, we can absolutely set up a call with myself, with Lee, with our CEO Kevin as well. Or if you want to just hit invest, then hit invest. But shoot me an email, nick@glampytech.com or nick@posh-outdoors.com. Doesn't really matter. And we will answer any questions that you have. We're excited to have you join us. But Lee, Connor, thank you very much.
It's a pleasure.
Thanks, Nick. Thanks, Connor.
Thanks,
See you
Lee.
soon.